Hello everybody there, Jason Wilson with Ursula Associates. So today's video we're going to be talking on the topic of the new Fannie Mae rules. Fannie Mae changed the rules recently on what it takes to qualify for a loan, and that mostly applies to what we call debt to income ratio. That is how much revolving payments show on your credit versus what the payment of the house you would like to buy is and what percentage of your income that totals. That's what we commonly refer to as the debt to income ratio. This is what kills most people, not really their credit score, although that is a factor. It is mostly that debt to income ratio. So the number one change that they made in there was for third-party payments. So it used to be that if you have student loan debt and those payments, let's just say they're $500 a month, they would count that against your debt to income ratio. So that means the house you can afford is $500 a month less. Well, if you can prove that a parent or a business even, like your employer, is actually paying this debt for 12 months consecutively prior to that, they don't actually have to count that debt against you. That is a major change, especially because a lot of people have their loans set up where their parents pay that debt, but it would still count against them. This is going to be a major shift for that. The second thing on there is how they calculated the payment. So Fannie Mae was just basically doing a liberal 1% of the total debt you have as calculated as the payment. So I'll give you a little math example. If you owed $100,000, they would basically calculate that $1,000 a month was what you needed to pay in your student loan. However, if you were in a forbearance or you were in an income base saying, I don't make enough to pay $1,000, but I do make enough to pay $180 a month, and they granted you a $180 a month payment plan, they would only use the $180 rather than the 1%, which was $1,000, to count against that debt to income ratio. That is also huge. And the third one that has happened is a refinance one. So this is for homeowners out there that had student loan debt, or their kids did, and you want to refinance your house with a Fannie Mae loan and use the equity in there to pay off that student loan. Of course, this only makes sense if your student loan interest rate is 8% and the new mortgages are 4%. Well, that would make sense. But if your student loan interest payment is 2% and mortgage rates are 4%, you wouldn't do this. The change they made there was they charged a quarter-point fee to be able to do that. Well, now they've waived that fee, basically encouraging homeowners to pull that debt out of the student loan area and put it into their home. So those are the three major changes that could affect you. If you have student loans and that is the reason you did not qualify, please give me a call.